Is student loan discharge taxable? Have you ever wondered what happens to your taxes if your student loans are forgiven? This is a question many borrowers face, and understanding the tax implications is essential. Student loan discharge means that all or part of your student loan debt is canceled. But is that amount considered taxable income? The answer can vary based on several factors. When the Internal Revenue Service, also known as the IRS, forgives debt, they typically view that amount as taxable income. This means that the money you no longer have to repay is treated as income for that tax year. However, there are exceptions to this rule. Some types of student loan discharges are not taxable. For instance, if you qualify for the Public Service Loan Forgiveness Program, the loans forgiven under this program are not subject to taxes. This program requires you to work in eligible public service jobs for a specific period. Another example of non-taxable discharge is teacher loan forgiveness. Certain law school loan repayment assistance programs also fall into this category. If a borrower passes away or becomes totally and permanently disabled, the discharged loans are exempt from taxation. Additionally, if your school closes or falsely certifies your attendance, those discharges are generally not taxable. In a recent development, the American Rescue Plan Act of 2021 provides temporary relief. It exempts forgiven student loans under income-driven repayment plans from federal taxation until the year 2025. On the other hand, some discharges are considered taxable income. For example, if you receive forgiveness after 25 years under income contingent or income-based repayment plans, that amount is taxable. Discharges related to unpaid refunds or other specific reasons can also be taxable. It is important to note that while the IRS has its rules, state laws can differ. Some states may tax forgiven student loans even if they are exempt at the federal level. For instance, California has recently created exclusions for certain student loan discharges related to school misconduct or closures. Colleges and universities have a role in guiding students about these potential tax consequences. Being aware of whether a discharge is taxable can help students plan their finances better and avoid unexpected tax bills. Institutions involved in loan discharge processes should communicate clearly about tax implications and any state-specific exclusions. In summary, student loan discharge can be taxable, but there are many exceptions, especially for public service employment, school closures, and certain federal relief measures. Understanding these distinctions is key to navigating your financial future.